Hey everyone, Kevin here. There's been a lot of talk about the market crashing again, this double dip recession. JP Morgan analysts are saying, hey, maybe gold is a play. A lot of people are saying, what about Bitcoin? We should get into Bitcoin to prevent being affected by that hyperinflation that's bound to come because of the trillions of dollars that Federal Reserve Chairman Jerome Powell is printing with his money printer. Well, a lot of these fears make sense. But what I wanted to do in this video is do a quick breakdown as to my opinion when I read an article like this one. This is 6 reasons why Goldman Sachs sees the market dropping. And I wanted to kind of share with you what goes through my mind as I look at those 6 reasons. We'll make it pretty quick, so let's hop right into it. So in this article, the first 2 reasons they suggest for the market dropping is a lack of share buybacks and a lack of dividends, or a reduction in dividends. And basically, this is just saying that companies are going through a period of uncertainty and they're starting to hoard cash, which makes a lot of sense. I mean, it's kind of what we're doing as well. You know, when this pandemic hit in March, I think a lot of us are like, dude, I need to get myself some more cash. We're drawing on credit lines where we have them. We're holding what we have. We cut expenses. We stop paying things that we don't think we need to pay right now. Postpone whatever we can. We take forbearance. Whatever we can do to protect ourselves and have more cash makes sense. And the same thing is exactly what's happening with businesses. With the exception of the fact that if you take mortgage forbearance, apparently your credit gets dropped like 40 points, which is pretty ridiculous. But personally, when I read articles like this, I compare what they're saying to my investing goals. For example, if I'm investing in Apple, yeah, my Apple stock might not go up as much as it would if Apple would continue buying back its shares, which just means creating more demand for their own stock, right? But Apple's winning in terms of the stay-at-home front. More people are buying computers and Apple iPhones or whatever. Even though there are supply chain difficulties, Apple is one of the leaders right now. Also, when I look at other companies like Walt Disney, who has cut their dividend, I look at a company like Disney and see, we have a Netflix competitor without the Netflix premium. Of course, it's anchored down by losses in the cruise ships and at the theme parks, and even some production is stalled. But to me, I don't buy stock in Disney for their 1.6% dividend. I buy Disney because I believe in the company over the next 30 years. If instead I wanted a good dividend stock, and I just wanted something that was gonna produce some cash for me right now, and a stock that at least I reasonably thought would continue paying this dividend, because they have been for the last 30 plus years, and they've never reduced it in those last 30 years, well, then I'd consider a stock like AT&T, which at today's price, under $30, one of my favorite price targets for this stock is 7%, which means if I put $1,000 into AT&T stock right now, I would get a check for $70 every single year doing nothing. So I agree, dividends getting cut and share buybacks not happening as much anymore is not so great. I don't know if that's gonna cause a 20% decline. Let's see what else they have in the article. The article cites reasons 3 and 4 as the Roni Ronas and reopening risks. And I have to give it to them. This is a very real expectation. This could very realistically lead the market to drop another 20% again. I don't think it's going to drop as much as what we saw in March lows, like March 23rd or even April 3rd, but it might exceed those. And here's why. Take a company like Dave & Buster's, for example. You know that company, I still go there, where you can play the video games that are all scattered around. I mean, that is like a perfect hotbed for contaminating surfaces and spreading germs amongst other people. I don't know that I see Dave & Buster's coming back until there's a vaccine. Now, their stock is dirt cheap. I mean, it's like just under $11, which based on their last year's earnings means you're paying about 4.7 times their earnings to own that stock, which is extremely cheap. It's almost kind of like it's priced for losses. And that's because they might be experiencing losses. See, here's how this works. Dave & Buster's makes about $1.3 billion in revenue. They get $1.3 billion coming in the form of you swiping that card and spending money on their carnival machines. I mean, their gaming machines. Yeah, no, wouldn't want to insinuate that by any means you're guaranteed to lose some of these games. And when they bring in about $1.3 billion in revenue, they tend to spend about $1.2 billion to service those machines and the leases for the space. The problem is it's only going to take about a 10% decline in revenues for them to have a loss with those operating costs. Now, sure, for every chicken sandwich that you don't serve, you have less costs, right? So maybe their costs will go down a decent amount as well. But it is quite possible a company like Dave & Buster's could see losses over the next year or two, especially since you can't really take a massive Dave & Buster's store and just say, all right, we have 30% less demand, let's just shrink the store by 30%. No, don't work too well. Now, don't get me wrong, I think Dave & Buster's is here to stay, but that is a long play, as in it might literally be 2 to 3 or more years to see substantial recovery in revenues at a company like Dave & Buster's. Now, here's number 5. This article talks about political risks, and number 6, the China trade deal risks, which to me, both of these are kind of political risks, right? Donald Trump is obviously fighting Joe Biden for the election. Depending on which president gets elected, we might see a lot of volatility in stocks. A lot of folks were enthusiastic when Bernie dropped out of the race. Why? Because that sent a signal that wealthier people weren't going to get taxed as much. But that came to the dismay of many people who don't invest in stocks, but who would have loved a form of universal basic income or more of a distribution of wealth. And that makes sense. And then we also know that Trump and the Republican Party are steadfast on making China pay for the Roni-Ronas, which is definitely a complicated thing. Think back to the last time we had a Chinese trade war. The stock market was in the toilet. But honestly, probably the biggest thing that could actually cause this 20 or more % sell-off in the stock market is the Chinese trade war. That is, we know that Donald Trump and Republicans are super steadfast at making China pay for the Roni-Rona. Obviously, there are investigations going on, everybody's waiting for more insights and data and trying to figure out what actually happened, but at least they're pretty verbally assaulting China for the Roni-Ronas. And only until recently was Trump 100% certain that he was going to punish China. Well, recently he did come out and indicate that he's right now torn on his existing Chinese deals and his agreements with China and what he wants to do about China. But here's what I can tell you about uncertainty. The last time the market fell substantially before the Roni-Ronas was at the end of 2018. And one of the biggest things that drove the stock market crash at the end of 2018 was China and the tariff battle that we were having between China. You might remember hearing about that on the news pretty much as we hear about the Roni-Ronas now. So, what should you do right now in anticipation of potentially a Chinese trade war, election drama, opening drama, Roni-Rona drama, and like, when is this vaccine-a-rama gonna come out? What should we do? Well, here's the thing. Anybody can talk big on YouTube, but I like to actually provide practical information that can help you make money. There's a lot of fugazi magic and hope and dreams out there about how you can get passive income doing absolutely nothing. My belief, for example, to you is that we should take all of these market fluctuations in stride and put a little bit of our money into the market regularly over time. Here's exactly how you can do it. Disney had a red day today, and using the simple platform Webull, I'm gonna go ahead and buy 10 shares of Disney right here. That's about $1,000 worth of Disney stock. It is after hours, so we're gonna go ahead and put in about 10 shares of that. We'll make it good till canceled, extended hours buy, and there we go. Now, what am I going to do if the stock falls another 10%? I'll buy another $1,000. What am I gonna do if in 6 months the stock drops 20%? I'll buy another $1,000. And it doesn't have to be Disney. If you're too uncomfortable with buying a single stock, that's totally okay. You could pick up the VOO, which I've shown you in other videos, and you could trade it exactly the same way. Just for giggles, let's go ahead and buy a share of the VOO right now. That means today I'll have put in this video about $1,200 to $1,300 into the market. If I do this on every single time, or every single red day, the way I call it, over time, my wealth tends to go up. As long as I don't get emotional if I see a red number. The red number is just a signal to me that I should buy more. And look, I know it's easy to say just buy more, but that's exactly why I recommend don't put your entire boat into the market all at once. A little bit every time. You got $5,000 to invest? Try it. Every time the market is red, put $500 in. Do it for 10 days in a row. and it's probably gonna take you somewhere around 30 days to actually spend it all. See how you feel and how much money you got in the market after those 30 days. And as usual, if any of this stresses you out, get yourself life insurance and do it anyway. You'll be better off in both ways if you do that. Join me in the program's link below, check out that coupon code, and folks, we will see you in the next video.